The Federal Reserve has finally done it. They have cut interest rates not just once, but twice this year. This is exactly what we have been waiting for, right? The news headlines that are cheering that the Fed is finally easing policy.
The Federal Reserve decided to cut interest rates for a third straight time.
Today's critical decision by the Fed comes as it tries to encourage hiring in the slow job market.
And your first thought is, great, my chance to finally afford a house. Mortgage rates are coming down. But then you open up Zillow, you call your lender, and you get hit with a cold hard dose of reality. The $500,000 house still costs $500,000, and the monthly payments are astronomically high. It feels like a scam. It feels like you're being lied to, and you're not wrong. The Fed are cutting rates, but you still cannot afford a home. Today, we're going to break down the 3 real reasons this is happening and what it all means for you. The good news is actually terrible news. First, let's understand why the Fed is cutting rates. It is not out of the goodness of their hearts. It is because the job markets, the engine of our economy, is sputtering and flashing warning lights. The official unemployment rate has ticked to 4.3%, but the real story is in the JOLTS report. That is the Job Openings and Labor Turnover Survey. Job openings are their lowest level in years, and the quits rate, the number of people confidently leaving their job for a better one, has plummeted. We're seeing a brutal combination of government shutdown, slowing things down, and the long-awaited AI takeover finally beginning. You have seen the headlines. Amazon cutting 14,000 workers, UPS reducing the workforce by 48,000, all while citing AI, robotics, and efficiency. Last month, we saw tens of thousands of job cuts announced, the highest in 2 decades. The Fed see this and is terrified of a deep recession. So they are trying to cut their short-term interest rates to try and make it easier for companies to borrow and hopefully stop firing people. This leads to the real problem. You think the Fed controls mortgage rates, right? Wrong. The Fed controls federal fund rates. That's the rate banks charge each other for overnight loans. This is a very short-term rate. A mortgage is a 30-year loan. Lenders don't give a darn about overnight rates. They care about long-term risks.
Thing is, they're at the highest level in decades. I mean, that is where the surprise could be.
I think they could be much higher than they are today.
And the number they use to price your mortgage is the yield on 10-year Treasury bond. And the Fed is cutting rates, but the 10-year Treasury yield is still about 4.14%, which is stubbornly high. Because the bond market, the people who are actually loaning out the money, are looking at the US economy and saying, no thanks. They see 2 giant problems the Fed can't fix: persistent inflation, and 2, massive government debt. The US government is borrowing trillions of dollars, flooding the market with new bonds.
Capital markets believe that Congress and the president are not going to get their act together. Everything unravels, and it unravels very quickly.
When you have a huge supply of something, bonds, and less demand because of the inflation fears, the seller is forced to offer a higher interest rate, a higher yield to attract buyers. The 10-year Treasury is the bond market telling you that it is still worried about the long term, even as the Fed is panicking about the short term. And that is why your mortgage rate is still stuck about 6%. But the final nail in the coffin is that the home prices are not even falling down. You would think that high rates and a bad job market would make the prices crash, but they're not. The median prices for existing home is roughly about $415,000, which is still over 2% higher than it was a year ago. No one who bought a refinanced home in the last 10 years at 3% or 4% wants to sell ever. They have golden handcuffs. So the only homes for sale are fewer that have to be sold, and the competition for them is fierce. And that is the great affordability squeeze. The Fed cutting rates sounds like help, but it is just a symptom of weak job market that is threatening your income. Meanwhile, the home prices are still rising because of low inventory. But the actual cost to borrow is not coming down because the 10-year Treasury yield is still high, keeping your mortgage rate stuck about 6%. So what's the solution? Well, first of all, you got to stop listening to Feds. They're not talking to you. And start watching 10-year Treasury yield. When you see that number break below 4% and stay there, that is the only sign that matters. Until then, protect your cash and stay patient.